updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 2:21 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg. Straight line lower from the left to the right. And we are at the lows of the day once again, with the S&P now down 82 points. A drop now of just over 2%, with the S&P at 39.96. We've got the Dow Jones Industrial Average down 688 points, down by 2%. NASDAQ is down 280, a decline there of 2.4%. The Russell 2000 lower now by 2.9%. 10-year yield 3.95%, with the 2-year yielding 4.72%. Spot gold is down 0.4%, 18.33 the ounce. West Texas Intermediate crude down 0.8%, 75.76 a barrel. A renewed surge in Treasury yields has taken the wind out of the stock market today. Geopolitical tensions also weighing on sentiment, and of course those dire forecasts from bellwethers Walmart and Home Depot. Home Depot shares down 6.6%. Walmart on the plus side up now by 0.4%. Again, recapping equities lower across the board. S&P 500 index now down by 2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Yes, indeed. All right, Charlie, thank you. Those equity averages hovering near their worst levels of the session. All right, so we got a question for you. How much is enough to retire comfortably? And that is a question that's caught Bloomberg listeners' and viewers' attention, and terminal users, because it is among our most read stories on this Tuesday. It's a question that our MLive Pulse team recently asked, Maddie.
And the team got some thoughts on the dollar amount that you're going to need to retire. We've got Suzanne Woolley, Bloomberg News personal finance reporter, here in our Bloomberg Interactive Brokers studio to answer that big question for us. Suzanne, go ahead and scare us. What's the big number that we need?
Wait. Take a step back. Tell us who we talked to.
Yes.
Okay. This is a weekly survey that we do, and we survey both professionals and retail investors from around the world, although the majority are in the U.S. and Canada, and it's heavy on the professional investors versus the retail.
Yeah, that of course influences what this big number is going to be, because It's a very certain demographic. But
yeah,
what did they say?
Yeah, basically they said you need $3 million in order to retire comfortably, which kind of blew my mind, and a lot of my colleagues in the newsroom were a little, verklempt.
Was everybody really shocked and surprised?
Yeah.
Okay.
I mean, I don't know. I've seen other surveys, like Charles Schwab did a survey, and they pegged it, their people they surveyed pegged it at about 2.2 million that you needed to feel wealthy, and about 775,000 to be financially comfortable. But I think 3 million, when you think of how many people don't even have savings or workplace retirement plans, don't have access to 401ks, 3 million is a big target.
It's a big target, yeah.
Are most people doubting that they'll ever have that amount?
Well, when you look at, say, figures from Vanguard, they have about 5 million plan participants across their accounts where they're a record keeper, and their average 401k there is around, I think, 112,000. Okay. And the median 401k there is more like 27,000.
So median meaning half or below, half above.
Exactly. So that's pretty telling. What was interesting is I've been getting some emails about this from both terminal subscribers and other readers, and one gentleman made the point that he has 7 401ks, and he said, at one of them he has $7,000. In 2 other ones, he has $1 million in each. So, the number, you have to take them with a little bit of a grain of salt, because, I personally have 2 401ks.
Yeah.
So that number could be low.
Yeah, but that's really telling that there's not a way for you as a reporter to get that data, right?
Yeah, it's difficult.
Yeah.
To cut across all the different providers to find that out.
Go ahead. No, you go.
Well, I just thought it was interesting too that we're saying this 3 million number, but almost as many respondents said you need 5 million.
I know.
Yeah, that's a big difference.
It's a big difference. I mean, I would love to know, we even had some people saying, 20 million and,
God. All
above 20 million, which was sort of like, wow, where do these people, I mean, granted,
They want to
only
retire
about,
on a yacht, basically.
yeah, exactly, on their own private island, okay?
Exactly.
I mean, granted, it was like 2 to 3%, but the fact that anyone said that is kind of mind-blowing.
I love, there's some great charts in this story, and I highly recommend you check it out at Bloomberg.com or on the Bloomberg terminal, because you do have, 1 in 10 portfolio managers is considering working forever. These are folks who know how to invest, are in it every day, so they understand the importance of it, and yet they are still nervous about being able to retire.
I think, yeah, I mean, it cuts across all income levels, and it's sort of, that's also the case with like your retirement target. I mean, we're saying 3 million, but how old are you? When do you plan on retiring? Where do you live in the country determines how much you'll need to save. Do you have kids you need to put through college? It's really, this is a big, interesting number, but in reality, it's a very personal number depending on how you want to live and where you want to live and
Right.
do you want to leave a legacy for your kids, things like that.
It's all about the very
Do
specific
you think
goals.
about retirement? You're young, you're much younger than I am, so do you think about retirement a lot?
I do. I think, though, because I got very lucky that my parents made it a priority for me.
So
They were
growing
like,
up or
yeah, like the second, because they didn't save for retirement. So
Yeah.
they were like, you need to do better than we did and prioritize this.
Smart.
But even though I'm saving and doing the best I can now, this makes me feel like a total failure. You know what I mean? Like,
Join the club, you
Right?
know?
Yeah.
I was actually reading some old letters from my mother, which were imparting like her wisdom. She was like, join the dividend reinvestment program, blah, 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 just trying to sort of
Drips.
help me. Drips, I know, drips. And, but I mean, I'm a good saver and I've been writing about personal finance for decades.
Yeah.
And, this number is not really feasible for me to reach.
Yeah.
Suzanne, one thing that I think is interesting too, and I think, people got spoiled the last few years, at least pre-pandemic, right? Money was cheap. You could throw money at anything. You could just buy the index and you did well, right? Certainly coming out of the financial crisis. I mean, it was pretty staggering. It's probably going to be a different market, many folks say, going forward. So did the survey kind of dig into maybe where investors want to think about putting their money to maybe maximize their returns?
Well, I think people think in the survey, we were asking, do you think the same mega cap tech leaders that brought us, that swelled our portfolios for so long are the ones that are going to lead us, up on the next leg? And the thinking was pretty much no. The majority were like, no, there's a new regime that's going to emerge. Although people did think that their 401k balances would be up at the end of this year over where they were in 2022, which kind of makes sense when you think about it, because I mean we're contributing money into it, so like duh,
It was a really lousy year last year.
Yeah.
But I wonder, with that volatility, if I can just sideline on that for a second, does that impact when people want to retire? You talked a little bit about people, 1 in 10 portfolio managers saying they're considering working forever. Do we know if those 1 in 10 were considering the downturn of the market as a factor to delay retirement?
I think everyone has to factor that in, and I think just emotionally, it's just pervades everything now. The uncertainty, there's so much uncertainty on so many fronts. We did ask people to sort of place the odds on, would they be able to retire comfortably, whether they place it at like 100% or 50% or 0. And, the retail investors, about 61%, were 100% sure they could actually maintain their future living standard. But the pros, it was more like 40%. And I don't know if because the pros have higher living standards or what. But,
That's interesting.
It was interesting, and it was like 5% of retail respondents said there was like a 0 chance that they wouldn't be able to maintain their lifestyle retirement. Well,
Wow.
So individual
9%.
investors versus institutional?
yeah, yeah. There's a different, there's some areas where they diverge. Like you'd expect, sort of, when we asked how much in retirement savings do you think is enough, the majority of retail respondents were said, less than 1 million, 1 million, 3 million. And after that, the percentage of retail investors dropped when we got to 5 million, 20 million, more than 20 million, of course. But that was the reverse for the professional investors.
To pick up on Carol's great question about where to put your money as well, can you talk with us a little bit about the outperformance of Asian stocks, the Asian market?
That was really the one we asked where people thought, in dollar-denominated terms, the highest return would come from. And Asia was what people were pointing to, followed by Europe. And so I think, you've got the China reopening, and we've obviously had a lot of action and a lot of volatility in the Chinese stocks.
Yeah, I find that interesting because the news out of Europe, we keep, recession, no recession, or things are coming in better than expected. And for a while, it felt like, certainly at the beginning of the year, a lot of money managers would come on and say, Europe is where we want to go.
Yes.
I don't know if that's cooling a little bit, but it's interesting to see the results of the survey.
That is interesting because, I had talked to a lot of investors over the years, and they were like, Europe is where the values are. The U.S. is not even cheap yet. Go to Europe. Maybe Europe's gaining on
All I know is it feels like it's early to kind of figure out how this year is going to play out.
This is true.
Already. Really some good thoughts. And as we said, this is among our most read on the Bloomberg. Suzanne, thank you. Suzanne Woolley. She's personal finance reporter here at Bloomberg News, here in our Bloomberg Interactive Brokers studio. But I do think it's something, yes, parents, remind your kids, start investing really, really early, right?
Yes.
That's how you build it up over time. All right, folks, let's get a check on world and national news. Off to D.C., Nancy Lyons in our 99.1 newsroom in the nation's capital. Hey, Nance.
Thanks, Carol. President Biden is vowing Ukraine will never be a victory for Russia, ever. He spoke today in Warsaw, nearly a year since Vladimir Putin launched his invasion. Biden says when the fighting began, there were questions about how the world would respond.
Would we stand up for the sovereignty of nations? Would we stand up for the right of people to live free from naked aggression? Would we stand up for democracy? 1 year later, we know the answers. Yes, we would stand up for sovereignty, and we did. Yes, we would stand up for the right of people to live free from aggression, and we did. And we would stand up for democracy, and we did.
Biden says it's important for NATO and other U.S. allies to remain firm in their commitment to push back against Russia. Well, his speech comes just hours after Putin himself announced that Russia will suspend its observation of the START treaty. It means Russia will no longer allow U.S. and NATO to inspect its atomic weapons. NATO Secretary General Jens Stoltenberg says the move makes the world more dangerous. U.S. Secretary of State Antony Blinken calls it deeply unfortunate and irresponsible. The Biden administration is taking control of Norfolk Southern's cleanup of the freight train derailment in eastern Ohio. As Bloomberg's Amy Morris reports, officials are eyeing the next steps toward train safety probes.
The federal government is eyeing enforcement tools and a potential emergency order from President Biden to improve rail safety as the National Transportation Safety Board works through what caused the derailment of a Norfolk Southern freight train. President Biden has yet to nominate someone to lead the federal agency that regulates the transport of hazardous materials, and lawmakers are working on legislation to make the transport of hazardous materials by rail safer, and they're promising more oversight. In Washington, I'm Amy Morris, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 2:41 on Wall Street. We check the markets all day long at Bloomberg. Slight bounce off the bottom, emphasis on slight. Right now we're looking at a 76-point drop for the S&P 500 index, back above 4,000 at 4,002, a decline right now of 1.9%. We've got the Dow lower by 650 points. That is a drop of 2%. Nasdaq is down 262, a decline of 2.2%. A renewed surge in Treasury yields is taking the wind out of the stock market. The 10-year right now at 3.94%, with the 2-year yielding 4.74%. Spot gold is down $7 the ounce to $18.33, a drop there of 0.4%. West Texas Intermediate crude down 0.2%, $76.16 a barrel on WTI. Well, as for the overall market backdrop right now, Liz Young is head of investment strategy at SoFi.
I do think the Fed still has to do more, and we all know about the long and variable legs that it takes for monetary policy changes to move their way through the economy. So I think equities are not offering a great opportunity here from a valuation perspective, because basically you would have to believe that we deserve to go through multiple expansion, meaning that prices deserve to continue going up without earnings growth to back that up.
Walmart's profit forecast for this year fell short of analyst estimates, signaling more struggles for the world's largest retailer. Walmart shares, however, are now higher by 0.3%, but Home Depot tumbling after the home improvement retailer forecast a fiscal year profit decline alongside plans for a $1 billion wage investment for hourly workers. Home Depot shares down 6.5%. It has never been this cheap to buy a Tesla, according to a Bloomberg analysis. After a series of price cuts over the past month, Tesla's Model 3 sedan now sells for $4,900 less than the average new vehicle sold in the United States. Tesla shares down now by 3.9%. Recapping, stocks lower, S&P down 1.9%, 10-year yield 3.93%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie, we've got an office pool for a Tesla in.
Yeah, that's an interesting concept. How much is it to get in on this? Yeah.
I don't know. We're thinking about
it. All right. I'm in. What would I do with a Tesla in New York, though?
I don't know.
I'm not a car guy. Leave that to, you know what? I would give it to Matt Miller. I would make him very happy with a Tesla.
He may have one already. All
I'm
right,
sure
Charlie.
he does.
All right, Charlie. Thank you so much.
Thanks so much, Charlie. So it is safe to say that along with being obsessed with the Tesla story, we have all become obsessed with balloons after that Chinese surveillance balloon found its way over the United States.
Well said, which is why we knew we wanted to bring you this story in the current double issue of Bloomberg Business Week, which is out on newsstands, online at Bloomberg.com/businessweek, and of course on the Bloomberg terminal. Let's get more. With us is Christina Lindblad, Global Economics Editor at Bloomberg Business Week. She's in our Bloomberg Interactive Brokers studio, along with Jeff Wise, Bloomberg Business Week freelance contributor. He joins us via Zoom from Westchester, New York. Christina, I want to kick it off with you. We are all obsessed about balloons, but they've been out there for a long time.
That's right. And as often happens when we are interested in things in the sky, we reached out to Jeff, who knows a lot about aerospace, and said, why don't you give us a little history of the balloons, and also what companies are, in this field now, and what could the Chinese have been trying to do with this? So maybe Jeff can kick it off by telling us, give us a little bit of a snapshot of how long these craft have been around and what they've been used for and what they're being used for now.
Well, thanks, Christina. It's such a back to the future kind of technology. People have been using balloons for literally hundreds of years to engage in surveillance on the other side in military operations. And here we are in an age when people are talking about hypersonic rockets and the like. We have this balloon floating overhead, and it turns out it's pretty hard to see. It's pretty hard to shoot down. And so I wanted to find out, well, what is it actually doing? What's the point of floating a balloon over someone like they did? And it turns out there's lots of handy things you can do, like sniffing out signal intelligence.
All right, so take us, Jeff, if you will, to a company that you write about in your story, Aerostar.
Right. This is a super interesting company. It was actually started by the guy who kind of reinvented the hot air balloon, used modern materials after World War II to make it the kind of hobby that it is today. We see hot air balloons floating all over the place, and you don't realize, oh, somebody actually created this technology and popularized it. This company went on to build high altitude balloons for the military, and they were able to do something that's harder than it sounds. If you fill a bag of gas with hydrogen or helium and float it up into the upper atmosphere, it eventually leaks out and comes down. But they figured out a way to basically keep these balloons up in the high stratosphere indefinitely. And that means you can float it kind of anywhere in the world for really months at a time. Their longest flight is over 150 days, almost 6 months.
Which it's pretty obvious when you say that timeline, Jeff, that these balloons can do a lot that planes can't. But can you talk a little bit about some of the other benefits that balloon surveillance might offer that a plane over an aerospace just can't provide?
Yeah, I mean, the first thing that came to my mind is satellites. I mean, the Chinese are flying satellites over us all the time anyway. Why not just use those? Well, it turns out that satellites have an important limitation, which is that if they're low enough to get really high resolution images, they're maybe 250 miles up, they're moving really fast. And as they go around the Earth, they only come back over a certain patch of ground, like maybe every day and a half or something. And so if you want to really have a long, lingering look at something, and look at it from even closer than 250 miles up, a stratospheric balloon is really a good option. Another cool thing about the modern stratospheric balloons, this has only really been possible in the last 15 years or so, is that by adjusting the altitude, you can insert this balloon into winds that are going in the right direction that you want it to go, and you can either park it over someplace on the other side of the Earth, literally, or you can put it in a spot and just keep it there. And so that's very useful if you want to look at something for a long time, which can be very useful for a surveillance operation.
Jeff, what do you think the Chinese might have been using the balloon that was shot over the Atlantic for? But there's a special technology they might be interested in, isn't there?
Yeah, exactly. There's this new kind of communications technology that the U.S. military has been developing that I had never heard of, but that it basically tries to conceal the signal so that it's difficult to intercept. It's called LPI, low probability of intercept. And basically, you're trying to hide your signal in the background noise. So you're actually trying to send it at as low power as you can get away with. That makes it really hard to detect, especially if you're far away. So this is the advantage of a balloon that's only maybe 20 miles up instead of 250 miles up. So it's much closer, and it's much more likely to sniff this out. This is just speculation. I don't know if this is what it's for. Aerostar doesn't know if this is what the Chinese are doing. But the U.S. military at this point definitely knows, because they have recovered the instrumentation that was on board this balloon that was shot down, and they're going to know exactly what the Chinese were after.
Jeff, what's wild in a world where I feel like defense, aerospace, everything is getting much more technologically sophisticated. Balloons seem so quaint, if you will, but it's not the Wizard of Oz balloon. As you say, there's some pretty wild technology on these balloons.
Yeah, it's much more high-tech than it seems, because while the idea of putting a lighter than aircraft up in the atmosphere is hundreds of years old, the way that they do it, the altitude that they get, and the way that they can control it is very sophisticated and actually quite hard to do. And it took them a number of years to get it right. And now that they got it right, clearly either the Chinese were watching them, taking notes, or maybe just developing it on their own, separate parallel path. But it is really a whole new technology.
Hey, real quickly, 30 seconds. It's a lot less expensive, right? Which makes it much more accessible to potential bad actors. Very quickly.
Yeah, I mean, it's very democratizing, because it's not too hard to put a balloon up in there compared to building a whole space rocket, launching it into space, tracking it, all that. So relatively more egalitarian, if you will.
I feel like we were all looking for this story, especially after how obsessed we've all been. Jeff, thank you so much. Jeff Wise, freelance contributor at Bloomberg Business Week, via Zoom from Westchester, New York. Christina, did you feel like you learned things about balloons?
Yeah, I love this story.
I do too. Christina Lindblad Ladd. She's our global economics editor at Bloomberg Business Week here in our interactive broker studio. As we said, this story is in the new current issue of Bloomberg Business Week, out on newsstands, online at Bloomberg.com/businessweek, and always on the Bloomberg. You are listening and watching Bloomberg Radio.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. A source tells Bloomberg United Airlines has delayed plans to add extra U.S.-China flights by at least 6 months as the two nations remain deadlocked over lifting COVID flight caps. The increase in flights was originally slated to start late next month, but the move was postponed over the weekend. The source says the airline has started to inform affected passengers. Shares of United, parent UAL, down now by just about 2.9%. Shares of Credit Suisse hit a record low this morning. The drop comes as Reuters reports that Switzerland's financial regulator is reviewing comments from a Bloomberg interview. It's looking at part of a conversation where Chairman Axel Lehmann said outflows from Credit Suisse have stabilized. Here's what he said from that interview back in December.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Credit Suisse Chairman Axel Lehmann speaking to Bloomberg in December. So far, both Switzerland's financial regulator and Credit Suisse are declining to comment on that Reuters report. Amazon's AWS has enlisted phone companies including T-Mobile US and parent Deutsche Telekom as partners to offer private wireless services to businesses. Right now, we have got shares of Amazon down 2.5%. T-Mobile US shares, they are lower now by just about 1.6%. After earnings, Home Depot down 6.3%, Walmart up by 0.5%. Those are some of the company stories we're following. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, more Business Week in just a moment. First up, though, let's get a check on the latest world and national news. Off to Nancy Lyons in our 99.1 newsroom in D.C. Hey, Nance.
Thanks, Carol. Well, President Biden is restating the U.S. commitment to the defense of Ukraine and the unity of the North Atlantic allies. He spoke in Poland today after making a surprise visit to Ukraine over the weekend. Bloomberg's Irv Chapman has more from Washington.
The president lauded the Ukrainians for their heroic and effective efforts.
Kyiv stands strong. Kyiv stands proud. It stands tall. And most important, it stands free. Yes, we would stand up for the right of people to live free from aggression, and we did. And we would stand up for democracy, and we did.
The president said Ukraine will never be a victory for Russia, and he assured the Russian people, the nations of Europe and the United States, are not seeking to control or destroy Russia, as Putin alleges. In Washington, Irv Chapman, Bloomberg Radio.
Federal environmental regulators are taking charge of the cleanup from the East Palestine, Ohio train derailment and chemical burn and ordering Norfolk Southern to do the work and foot the bill. EPA Administrator Michael Regan says the railway will be held accountable.
If the company fails to complete any action ordered by EPA, the agency will immediately step in, conduct the work ourselves, and then force Norfolk Southern to pay triple in cost accordance to the powers granted by my agency.
Regan says there's no way Norfolk Southern will get off the hook for, quote, the mess they've created. Transportation Secretary Pete Buttigieg is also vowing to strengthen regulations concerning high-hazard flammable trains. Alec Murdaugh's only surviving son has been on the stand today in Murdaugh's South Carolina trial for the murder of his wife and son. Buster Murdaugh, testifying for the defense, says his father broke the news in a phone call in which he says he sounded odd. He also told jurors his father had been destroyed and heartbroken following the murders. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Carolyn Madison.
All right, Nance, thank you so much. Bloomberg Business Week brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. Your small to medium-sized business could be missing out on an opportunity to claim the Employee Retention Credit. Innovation Refunds has helped thousands of small and medium-sized businesses claim over $3 billion in ERC refunds and may be able to help yours as well. Learn more at getrefunds.com.
And as we've been discussing all month, February is Black History Month, and every day of February we are celebrating significant moments in U.S. Black history. So with your installment for Tuesday, February 21st, here's Bloomberg's Justin Milliner. Hey, Justin.
Hey, Maddie, thank you. On this day in Black history in 1965, Malcolm X, one of the most well-known and passionate faces of the civil rights movement, was assassinated. Malcolm X was born Malcolm Little in 1925 in Nebraska. As a young man, he moved up north, spending time in Harlem, New York, and later in Boston, where he was arrested after committing a series of burglaries. It was while he was serving a multi-year sentence for those crimes that he became involved in the Nation of Islam. Once out of jail, he quickly went on to become one of the most prominent members of the movement. While he's remembered for being an important activist in the civil rights era, his life was not without controversy. Malcolm X's sometimes extreme viewpoints put him at odds with many other communities, including with other civil rights advocates like Martin Luther King. All told, Malcolm X's legacy is that of Black empowerment. His influence gave way to the Black Power and Black arts movements following his passing, both of which conveyed a message of Black pride and raised the self-esteem of Black people. And that's today in Black history, Carol and Maddie.
Yeah, certainly an important figure.
Absolutely.
In the Black community.
Very influential.
Yeah, absolutely. All right, Justin, thank you so much. Bloomberg's Justin Milliner with Black History Month. All right, folks, we're going to head over to our TV colleagues, talk a little bit about the trade today. We've seen yields move up in a big way. and we do see pressure on the equity markets. Madison and I heading over to our TV side for our simulcast on radio, TV, YouTube, and Bloomberg Originals. Countdown to the close starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close with 60 minutes left in the trading session. Vonnie Quinn and Shonali Basak, joined now by our colleagues Carol Masser and Madison Mills and for Tim Stenavec. We together welcome in our full Bloomberg audiences across TV, radio, and YouTube. And it's down day, guys. Pessimism permeating Wall Street, it seems, after the long weekend.
Yeah, absolutely, Vonnie. And we're seeing it pretty broad-based. And I have to say, some news overseas certainly getting my attention, bringing me once again to look at those Chinese names that trade here in the United States. So the NASDAQ Golden Dragon China Index, it is definitely underperforming here. It's down about 3% in today's trade. You've got JD.com, top decliner in the NASDAQ 100, down 11.5%. Pinduoduo, it is down about 9.7%. Alibaba, almost a 5% decline. So we're seeing it across the board. What's going on is China's internet firms, they're revving up efforts to outdo each other since Beijing began to wind back its bruising internet crackdown. So basically, there's fears of price wars as China seems to dial back on some of its regulations. So nonetheless, Maddie, we're continuing to see the sector under pressure. And also, to be fair, there's a risk-off trade today.
Yeah, a lot of selling off happening today. And part of that, of course, is related to the domestic story. We have to look at the consumer here, of course, right? We've got that PCE data coming out on Friday, but take a look at this chart. This shows us PCE core services ex housing. We all know by now that's Jay Powell's favorite metric. The Fed wants to see that blue line showing the annual percentage change of personal consumption expenditures coming down. So the question on our minds, of course, is what the path to get there looks like, Vonnie, and what that PCE number that we get on Friday morning is going to do to markets.
Absolutely. We hear more and more about the consumer as we head throughout the week. TJX reporting tomorrow as well, Maddie. So take a look at the majors. We are off our session lows, but we'll see if that holds. The S&P 500 just crept back above 4,000 in the last few minutes. Down by 1.9% though. 4 stocks lower to everyone that's higher, and it's really only the commodity stocks that are higher. We have everything lower from the chip stocks to the home improvement retailers on earnings, and also on this idea that the Fed is going to stay higher for longer. As you can see, the majors there, the Russell 2000 and the Golden Dragon Index that Carol was mentioning there, down more than 3%.
Yeah, I want to bring you into the sectors here because, as you say, it's a down day. It's a bad day across the board for every major sector in the S&P 500. Energy is less bad than everything else, down less than 0.1%. But consumer discretionary, after a lot of earnings coming out, you have it down almost 3% on the day. Information technology down more than 2%. Real estate, industrials down more than 2% on the day. Financials as well, despite that big move up in yields. Financials not getting any love today. We're going to talk about individual movers as well. It's not all red when you look at the movers on the day. The S&P 500, General Mills is up on the day. Their earnings were a little bit better than expected here, but then you have Nordson Corp, a different end of the barbell here, because they're seeing order delays into the second half of this year, a step down in order entry, lowering guidance there. That is the worst performer in the S&P 500, down more than 13% on the day, following Carol into the Chinese stocks as well. JD.com down more than 11% on the day in the NASDAQ 100.
And as we see the 10-year yield rising 13 basis points today, the 2-year yield rising 11 basis points. Carol, one of the questions we're asking ourselves is at what point do we see the pinch point for stocks? If you take a look at this Bloomberg terminal, you'll see that stocks are losing their risk premium. So if you base that on the earnings yield minus the 10-year rate, we're seeing that at a low today. And that's one of the reasons why Mike Wilson says, you know, we're really not getting any kind of risk premium advantage anymore in buying stocks, and maybe that's another reason why we're seeing a little bit of a sell-off today.
Absolutely. When that yield premium looks more similar between what you get for the equity side of things versus the treasury, there's less risk in treasuries, and so you understand investors thinking maybe that's a better option. Having said that, in terms of progress, Jan Hatzius, he is Goldman Sachs chief economist. He says we're making progress, or the Fed is, when it comes to inflation. He doesn't think a recession is happening, or at least there's less recession risk. But he does say in an exclusive interview with Bloomberg earlier today, he says the Fed expected to be continuing to be vigilant when it comes to fighting inflation. Here's what he had to say.
We've seen some higher inflation numbers for January. I don't necessarily think that breaks the trend towards disinflation, but I think it reinforces the idea that the Fed still has work to do. And so we think another 75 basis points from here with no cuts until 2024 seemed like a more likely outcome.
All right, of course, that's Jan Hatzius. He's the chief economist over at Goldman Sachs. So kind of interesting, and Maddie, really kind of piling onto that thinking that we heard from a lot of Fed speakers, including Jay Powell, that the Fed is going to continue its fight when it comes to inflation. Maybe that means being a little bit more aggressive.
And maybe that means 25 basis points at the next meeting or 50. What I've been thinking about is that these two Fed officials we heard from last week who mentioned the 50 basis point anticipation for the next meeting, they're not voting members. And I wonder to what extent that matters. Shonali, I feel like that's a question I got to ask Mike McKee the next time we have him on.
I know, seriously. And when we look at the Fed minutes tomorrow as they come out, what the Reserve officials have to say about the path forward, we knew that it was going to be higher for longer. Now the market is finally catching up. But again, to what extent does this start to become an earnings story as much as it is a Fed story?
Yeah, and to what extent do we actually start to price out those rate declines that we were seeing at the end of the year? So we're definitely seeing, more and longer rate hikes being priced in, but we have to price out some of the ones on the other side too, Carol.
Yeah, no, absolutely. What's interesting, if you look at swaps right now, you are looking at market indications of 25 basis point hikes for the March meeting, the May meeting, and the June meeting. So we're carrying it out through June. At that point, keep in mind, March, we'll get a further assessment. We'll get a new dot plot when it comes to the Fed. So we'll get some clues into terms of how those Fed officials are thinking about the outlook and what happens with rates throughout the year.
And I wonder too, Carol, to what extent what we're seeing in the market today is about the Fed and that terminal rate, or some of this consumer data that we've been getting, and even earnings information that we're getting from Walmart, from Home Depot today. Shonali, when you were doing those gainers and you look at that consumer discretionary just deep into the red, I wonder how much we have to think about that, Vonnie.
Well, exactly. And as we see the curve begin to steepen again now, that's what a lot of strategists are pointing to in terms of a warning signal for a recession coming, because we're seeing the front end steepen a little bit, Shonali, and they say that comes right close to a recession.
Yeah, speaking of the recession, you take a look at the yield curve. It's a breathtaking move today in yields, the 10-year included, and you have to wonder what that sell-off really means for longer-term equity.
Yeah, the 5 and year both hitting new highs for 2023, and you do wonder, is this it? Is this the new range, or do we still have higher to go? All right, guys, we've got more to talk about. Our cross-platform coverage, we will be back in less than an hour on radio, TV, on YouTube, and also on Bloomberg Originals. We will count you down to the close, Beyond the Bell. It's coming your way at 4 p.m. Wall Street time. Earnings stories, market stories today, no doubt about it, is something that we just touched upon, and that is Walmart, which came out with its earnings. The stock, we've seen it down as much as almost 3%. It's been up as much as 1.3% right now, holding on to a gain of about 0.5%. And this has to do with kind of the mixed news, Maddie, that we got from this massive retailer.
I love watching news like this throughout the day, because it's just fascinating to see that huge drop off, and then suddenly everyone gets together and decides it's okay to like Walmart again.
All right, so let's get into it with someone who follows this company very closely. First up, though, we do want to mention that the CFO of Walmart, John David Rainey, he did actually join our team earlier on Bloomberg. He specifically, for a little context, addressed how consumers are getting more selective. Here's what he had to say.
What we've seen in the most recent quarter is that we've actually had share gain from some of the lower and middle income buckets as well. And so as these consumers are being more discerning, as they're looking for value, and importantly, in a world where convenience really matters, our value proposition is resonating with them.
All right, that, of course, is John David Rainey. He is Walmart's CFO and Executive VP, joining our Bloomberg team earlier today. With more on Walmart, let's head to Dallas, where we find Bloomberg News U.S. retail reporter Brendan Case. He joins us via Zoom. Hey, Brendan, it's good to have you here with Maddie and myself. So let's talk about the Walmart story, because it was a little bit of good news and a little bit of not so good news.
Yeah, that's exactly right. I think there were two big messages coming out of the earnings report today, and one was that the fourth quarter was really strong. They had, U.S. comparable sales, excluding fuel, of over 8%. That's the second straight quarter. And, except for like the pandemic when everybody was stuck at home and had a lot of money to spend, those numbers are really high on, a historical basis. What it means is that a lot more people are doing a lot more shopping at Walmart, kind of looking for that refuge from higher prices. That was kind of the good news. The bad news is that their outlook was a little weak, both in terms of earnings per share, comparable sales, came in below Wall Street expectations. So they're definitely signaling a measure of caution there. The twist, of course, is that there's a lot of Wall Street analysts who are kind of saying, well, they're setting low expectations, all the better to outperform them later on as the year goes on. Whether that turned out to be true, we'll see.
That was going to be my exact question for you, Brendan, whether or not this is something that companies do to kind of hedge themselves against any potential future failure that might happen. Do you know to what extent that is accurate as part of Walmart's story, or is this just analysts guessing at what's going on with Walmart?
Yeah, it was certainly a matter of almost like a consensus among analysts. I'm not sure if every last one of them said it, but, Evercore, Morgan Stanley, Jefferies, they were all sort of hitting the note of like, this is a very conservative outlook. It could be pretty easy to sort of over-deliver based on these commitments. Now, what's going through Walmart's mind? I mean, last year, you got to remember, they came in with a pretty good annual outlook for earnings growth, got absolutely crushed by a surge in inventory that then forced them to be marking down a lot of merchandise for, 2-3 quarters. Ended up with a decline in earnings per share, which was not the plan originally, ended up with a lot of sort of egg on their face. I think this year what they're doing is they're saying, look, we can pretty much say with a great deal of certainty we can hit these numbers, whatever happens in terms of the broader macro environment. I might guess that there's some potential for upside there, but I don't think that they're necessarily, that's sort of front of mind for them. I think they're trying to figure out what they can really commit to credibly right now.
How do you read this as we get ready to hear from a lot more retailers, right? We have Costco, we have Target next week. We talked at the top of our broadcast. Target is down about 3.5%. You've got Kohl's down almost 10%. I think Costco was down earlier this morning. I'm just going to take a look. It's still down about 1% here. So how do you kind of broaden out the story, Brandon, or do you not?
I would. And I think that the thing at least one way to think about this, or sort of one lens to look at it through, is the split between, consumer staples and consumer discretionary. So you get a company like Walmart that gets, about 60% of its revenue from groceries and consumables. And it's using that to get a lot of people in the door because you have to buy that stuff. And once you're there, maybe you end up buying, a little something extra. You take a company like Target, or even more so, Kohl's, the department stores, and what you're really talking about is a preponderance of discretionary items. And, those have been under a lot of pressure for the better part of a year now. And I think that what you heard out of Walmart today was a lot of strength in grocery, not so much in general merchandise. So, in other words, clothing, home goods, toys, sporting goods, that's all still under pressure. And so if you have a business, like Target does, that depends a little more on that kind of item, or you're a department store and you're a lot more discretionary, Costco's kind of a mixed bag in that regard. But, I think what the big question will be going into next week is, what does 2023 look like if you're more on the discretionary side as compared with Walmart that's more on the staple side. You got a little clue today with Home Depot, being down quite a lot. because of some uncertainty about whether the kind of the do-it-yourself market's gonna hold up.
What was it that changed the story for Walmart today, Brendan, from your perspective? Was it something that John David Rainey said during the earnings call? What flipped the market on Walmart today?
I think there were probably two things. I think one is that the outlook initially was a little bit of a shock, and you saw shares go down pretty fast to down 4% in early trading, ahead of the market open. They got back to, something, sort of smaller declines during the conference call. And I think probably two things happened. One is that I do think that there's probably some investors out there thinking this is a floor, but Walmart has a lot of room to outperform these goals, number one. And then number two, I think one thing that they stressed on the call is that even though the sales increase that they're forecasting is lower than their long-term goal, they're forecasting 2.5% in comp sales, and generally speaking, they want to be up around more like 4% for total sales. But at the same time, what they're saying is that operating profit is probably going to grow faster than that. And so I think what they're saying is, look, maybe we're going to be a little under pressure. We're taking a cautious outlook in terms of consumers, but we're still going to be able to make pretty decent profit off of what we sell.
Hey, Brent.
And I think that was,
Brendan, one thing I want to ask you, there are certain CEOs or certain companies when they say something like, we just don't know, or certain economists or market watchers, that the hairs on the back of your neck kind of stand up. And Letitia Miranda, who is a Bloomberg Opinion columnist, has a column out about Walmart today and says what Walmart doesn't know should worry us all. And she mentioned how the CFO on that call with investors said the company's being cautious because there's just a lot we don't know. That's a direct quote. Is there something to be said from that when Walmart, their C-suite is saying that you kind of have to sit back and take note?
I think so. I think that's a really good point. And I think that, one thing that you heard from John David Rainey, the CFO, is that they've got some doubts about consumer balance sheets, and they've got, some concerns about the savings rate. And so, he said on the interview with Bloomberg TV that, if anything, the company has been surprised by the resilience of the consumer so far. Sort of reports of the demise of the U.S. consumer have been sort of greatly exaggerated so far. But there could come a time when the balance sheets weaken, people are under more pressure from rising interest rates, different kind of economic environment, that things really start to head south and that people feel a lot more pressure. I think that Walmart will be the first to say that time will tell. It's not quite seeing the impact of that this second, but that is a concern. They talked a lot about the uncertainty for the second half of the year.
Really quickly, we've got like 20 seconds, Brendan. What do you think is the outlook for Walmart if we do head to that recession? Is that good news for Walmart?
Well, it's good news on a relative basis because what they'll do is they'll get a lot more business that will go away from other higher priced retailers. Yep. But it's not necessarily good news for its core fundamentals. They're going to be under pressure too. It's just that on a relative basis, they might look a little better.
All right, great analysis. Brendan, thank you so much. Brendan Case, he's U.S. retail reporter at Bloomberg News, joining us via Zoom from Dallas. The CFO on that call with investors said, here's a quote, "We could tilt into a recession. We don't know what happens to consumer spending. We don't know what happens to layoffs, household income." He said, we're so early into the year and there's a lot of unknowns right now. So that's kind of laying the stage, if you will, for 2023. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We check the markets all day long on Bloomberg. We have got the S&P 500 index right at 4,000. It is a down day across the board. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks under pressure as the 10-year yield hits 3.95%. Dow's currently down 655 points. S&P's dropped 78, and NASDAQ is down by 2.4%. Gold is down 6. Oil is little change. Bitcoin is lower by 0.6%. And among the main 11 SP sectors, all were trading in the red, led by losses in consumer discretionary and tech. Leaders to the upside in the Dow, Walmart and Procter & Gamble, while Home Depot fell 6.6% after earnings and led to the downside. Also after earnings, General Mills rose 4.8%. And in other news, Microsoft's Smith announced a deal with NVIDIA. Wrapping things up, some of the names reporting after the bell tonight include Palo Alto Networks and Toll Brothers. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over at your Bloomberg, type SQUAK, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening and watching Bloomberg Business Week on this Tuesday. Carol Massar along with Madison Mills. And this story definitely caught our attention. It's about how it's never been this cheap to buy a Tesla. So let's get to it in another edition of Bloomberg Plugged In, which, as you know, is our weekly look at EVs.
Yes, we are very excited to have the co-host of Bloomberg Technology, Ed Ludlow, with us from our Bloomberg 960 studio in San Francisco. Ed, thanks so much for making time for us today. Tell us about these Tesla prices, undercutting the average U.S. car by almost $5,000. How is this happening?
Yeah, this is some terrific number crunching by the team at Bloomberg Green. And I would say that saying how cheap it is definitely a relative term, because it's relative to the average new car price, right? It's still pretty expensive. But we're in a situation now, right, where the average new car price in this country, the United States, hit above $47,000 in January. And actually, if you look at the cheapest available vehicle that Tesla does, the base version of Model 3, you take into account the $7,500 federal tax credit. And this is a vehicle that is basically more than $10,000 cheaper, right, than the average price. They've even gone as far to like compare the lease payments on that vehicle to a Toyota Camry. And it's cheaper than a Toyota Camry. It's even cheaper than the base model of a BMW 3 Series. So the point that they're getting at in this number crunching is relative to their combustion engine cousins. Things are getting cheaper. And remember, a big part of this story is Tesla cutting prices this year more than once as a lever to induce demand.
And others have followed, some, correct, Ed?
Yes, exactly. So, you know, the first cuts came in January 12. They were pretty deep from Tesla. Very quickly, Ford followed suit, right, on the Mustang Mach-E, which is its kind of highest volume electric vehicle of the two that it does on the consumer side here in North America. And you have analysts on Wall Street dubbing this the EV price war already. You know, even though we're still in the kind of early stages of penetration, just a few single-digit percentage points of overall sales at EVs here, we have a price war where everyone's trying to undercut each other. But remember, the context here is these prices are relative to the average price for a combustion engine car.
And Elon Musk is kind of changing prices a lot at Tesla, right? Like, this isn't super unprecedented, Ed, is that correct?
No, it's not. And look, you know, on the earnings call from the fourth quarter earnings, Musk said that in the first 2 weeks of 2023, basically January, the demand for their electric vehicles was twice what they were able to produce. So cutting prices clearly had an effect. It induced a pocket of demand. But in the past, what Tesla has done, if you go back to 2021, the last time that, and again, I wouldn't use the word cheap, I would say cheaper relative to combustion engine cars. What they did is actually, when we hit those record relative levels, they raised prices very quickly thereafter. In China, what's happening is really interesting. We've reported, according to sources, that they've kind of shut down and slowed down the assembly line in China to make upgrades. Why? Because they're bringing out the latest, updated, higher spec version of the Model 3. And hypothetically, we could see that carry a higher price in that market as well.
What does this do then, do you think, to car sales? Does it juice it in terms of the EV side of things?
You know what's, it's really difficult to answer that question. I don't know if you saw last week's Bloomberg Big Take that David Welch did with Keith Norton, but they went even further in crunching the numbers, and they compared the average monthly payment for a new car, which they found to be $777 a month in this country, to the ones globally. And we're seeing prices higher in all countries. EVs are actually a big part of that problem. So here we are talking about how EVs are cheap relative to combustion engine cars. That's in specific cases. As a rule, there's a 25 to 35% premium for the cost of an EV over the cost of a new combustion engine car across markets globally. You know, what we're talking about in Tesla is a specific example where they're discounting for the short term, and that won't be permanent. We know that the discounts have brought in demand, but when the prices go up again, we still know the consumer's under pressure, so it's hard to know how the longer-term effect will play out.
I have to say, Ed, my husband and I were just looking at cars too, and it was just like, oh my God, how expensive like cars have gotten.
Yes.
Having said that, from Tesla's vantage point, are they trying to, though, kind of bring in more consumers at this point? And do they have an advantage because they're out in the market, they're established, you know, in terms of the EV world? Is this just kind of a smart strategy on the part of Elon Musk? How is the industry looking at that?
Yeah, I think their advantage is their volume of production. Okay, so they basically produce more EVs than anyone else. They are also not transitioning, right, from combustion engine to electric vehicle. So them using price cuts as a lever, they have more freedom to do that. One of the things that Ford, for example, as a comparison talks about when it cut prices was actually profit for them is really distant. These are not profitable vehicles, they're electric vehicles. One way of getting around that and improving margins is just to produce them in higher quantities. And that's a big part of Ford's strategy for this year. But again, the consumer is under pressure in all kinds of markets. What you do is you find the addressable demand by cutting prices. You unlock new areas of demand that weren't there at the higher price point. The thing that we don't know is what happens when Tesla puts prices back up again. And as Maddie asked me about, they have done that in the past. So it's a kind of wait and see kind of scenario.
Wait, Tesla doing a 180 or Elon? No, it never happens.
Unthinkable. Unthinkable.
Unthinkable, Ed. And I know that some of our colleagues on the opinion side have reported on this, and you know it well as well, but this is helping Tesla's profit margins a lot when compared to like a Toyota, a Volkswagen. Is that going to remain sticky with this price cut?
Well, look, margins are the principal concern of Wall Street and analysts when Tesla cuts prices. You look at all the sell-side notes, it's the first thing they look to. That said, Tesla has automotive gross margins that are the envy of the entire industry. They're at a level that no one has yet achieved. And part of that is that scale, but they also have more flexibility and nimbleness in the supply chain. We saw that during the semiconductor shortage, or when we saw some of the commodities inflation of 2021 into 2022. They are sort of have more organized and longer term supply contracts on the raw material side, which has helped them protect margins. Whereas, you know, the rest of the industry, Ford and General Motors, they're kind of catching up, right? They're trying to establish newer supply chains where they have less flexibility.
And what would you say is the single biggest thing that allows Tesla to have that flexibility to pivot in the face of something like a semiconductor shortage?
Yeah, based on my reporting and what sources tell me is Tesla operates in the Tesla way. They do things completely logically, right? Elon Musk always says to his people, why can't you do that? Or why are you doing it this way? Do it differently. Even if it bucks the norm of the automotive industry, they just do things their way, and they've proved to be much more quick reacting, much more direct. And of course, the kind of boring old school way of looking is they have a vertically integrated supply chain where they have much more direct relationships with the raw material suppliers upwards.
You know, it's kind of fascinating because for such a long time, this is not what Tesla needed to do. But I also do think, Ed, it speaks to that bigger, broader story, right, of more competition also coming into the market. And this is just, you know, Elon kind of acknowledging that.
Yeah, I think also, as you guys kind of hinted at, they are a little bit inconsistent in strategy. So if you think back 2 or 3 years ago, Carol, when you and I were on this program talking about how the $25,000 EV was the ultimate goal, they had to get there. Right. But then they kind of abandoned plans for a cheap EV for everyone. Now, March the 1st, Investor Day coming right up, we think this is going to be a story about mass scaling of production and working towards a vehicle that's probably more affordable or indeed a complete robo-taxi. And that changes the economies of scale that Tesla's working at and thus impacts their financials. So they're kind of inconsistent with their goals in the short term, but I think on March the 1st, we'll find out a lot about the next 10 years for this company.
Why? What's March 1st?
Investor Day. It is their Investor Day, and they've kind of teased it with this photo. And if you look really closely, it's lots of metal frames of vehicles lined up, thousands of them. So we think it's about how they scale to a much higher level.
Well, it's funny, and I think about what Mary Barra told David Weston. Of course, she's the CEO of General Motors, right, last week, that she said GM needs to sell $30,000 EVs to reach the bulk of buyers, and that gets to that price point, right, Ed, which opens it up to the masses. Just got about 20 seconds left.
Yeah, that was the point of this story that's out today and that story last week, that the price is so high now for the median income household. We need to see them come down for mass adoption of EVs, and track the Bloomberg NEF forecast. 2026 is when we think we'll see price parity now on EVs and combustion engine cars.
Love that. All right, Ed Ludlow, thank you so much. Ed Ludlow, co-host of Bloomberg Technology at Bloomberg News. Catch him at 5 p.m. Wall Street time on Bloomberg Television. Ed, of course, joining us from our Bloomberg 960 studio, in San Francisco. Maddie, just checking out shares of Tesla in what is an overall broad-based down day for the equity market. You've got shares of Tesla just down about 4% here in the trade. If I look at Tesla so far this year, they're up 62%.
Wow, still a good year.
Yeah, definitely a bullish one. All right, let's get back to world and national news. Nancy Lyons, she's in our 99.1 studio in D.C. Hey, Nance.
Thanks, Carol. President Biden says the world has not looked the other way as Russia wages war on Ukraine. While speaking in Poland today, he said the democracies of the world have grown stronger.
The autocrats of the world have grown weaker, not stronger, because in the moments of great upheaval and uncertainty, that knowing what you stand for is most important.
Biden is warning there will be hard and bitter days ahead, but the U.S. and its allies will stick with Ukraine for the long haul. He says Russia will never achieve victory. Biden's comments follow Russian President Vladimir Putin's first State of the Nation address in 2 years, in which he announced Russia is suspending its observation of the New START treaty with the U.S. that limits their nuclear arsenals. He also vowed to press on with his unprovoked invasion of Ukraine. The Supreme Court seems wary about opening internet companies to lawsuits stemming from harmful user posts. Bloomberg Supreme Court reporter Greg Storr says today's argument centered on a law, Section 230, that protects the media platforms. The case involves a lawsuit filed by a father who lost his daughter to Islamic State militants and argues that YouTube should face lawsuits by proactively recommending Islamic State videos.
If YouTube puts on your screen a queue of videos that you might be interested in, is that the kind of thing that Section 230 shields? And the family of a terrorist victim says no, and they're asking the Supreme Court to let their suit go ahead.
Bloomberg Supreme Court reporter Greg Storr says tomorrow the Supreme Court hears a related appeal by Twitter in a case stemming from a terrorist shooting in an Istanbul nightclub. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:41 on Wall Street. I'm Charlie Pellet. We check markets all day long on Bloomberg, and we begin with a developing story, a headline from the Bloomberg Professional Service. The management consulting firm McKinsey is going to cut about 2,000 jobs in one of its biggest revamps. McKinsey, based in New York City, it has about 17,000 employees, according to Bloomberg data. So again, the headline from the Bloomberg, McKinsey cutting about 2,000 jobs. The Dow, the S&P, and NASDAQ all on the minus side. We have got the S&P now lower by 75 points at 4,004, drop there of 1.8%. Number of cross currents today. The Dow, by the way, down 640 now, down 1.9%. We've got NASDAQ down 275, a decline of 2.3%. A renewed surge in Treasury yields, taking the wind out of the stock market, with the 10-year at 3.94%, the 2-year 4.72%. Gold is down 0.3%, $18.35 the ounce, while West Texas Intermediate crude oil is down 0.2%, $76.16 a barrel. Earnings also rattling investors. Home Depot, member of the Dow, down 6.6%. Walmart lower now by, or higher actually, by 0.6% on Walmart. As for the market backdrop, Stephanie Roth is senior market strategist at J.P. Morgan Chase Bank.
The risk is very much to the downside from here. The market seems to be pricing in this really optimistic outcome that I don't think is right. I think the narrative right now is wrong to some extent. There's this excitement about the data that we've seen, that payrolls came in really strong and retail sales came in really strong. A lot of that is seasonal noise, and we have to look through that to some extent. And what we're seeing is inflation that's sticky and an economy that's showing some cracks beneath the surface.
And again, we've got the 10-year 3.95%, the 2-year 4.72%. West Texas Intermediate crude down 0.2, spot gold down 0.3%. Among the names scheduled to report after the close of trading today, we'll be hearing from Caesars Entertainment. Caesars down now by 2.7%. Palo Alto Networks down by 1%. Also reporting after the close of trading, home builder Toll Brothers. Toll is down 2.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week, brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. In about 8 minutes, you can find out if your business qualifies for employee retention credit assistance. Innovation Refunds has helped thousands of small to medium-sized businesses claim the ERC and may be able to help yours as well. Time is running out to claim the ERC, so get started today. Learn more at getrefunds.com.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got just about 16 and a half minutes left in today's trading session in this holiday shortened trading week. We got 4 days to come here, but just getting ready to wrap up the Tuesday trade. You heard Charlie talk about it. Equities, there is a sell-off. We've got yields moving up to the highest levels we've seen since about mid-December. Equities, though, just off their worst levels of the day. So let's get to it. Let's get to our drive to the close guest. He is Michael Sheldon, Chief Investment Officer at Hightower RDM Financial Group. They're a wealth management firm, and he joins us via phone from Westport, Connecticut. Michael, nice to have you back here on Bloomberg Radio. So talk to us about the macro, the sentiment. It's funny, my daughter is studying economics, and she's like, hey, Mom, consumer sentiment, did you know, or sentiment, market sentiment, how much it can affect the trade? It's really funny to have these conversations. The sentiment does feel like it's getting a little bit worse and a little bit more negative. How do you view the markets right now?
Well, we've gotten off to a pretty positive start to the year. January was one of the few months where the markets were actually up 6% or more. That's only happened, I think, 7 times since 1970. So January was certainly a positive month, and that follows the bottom that we had in October of last year. So I think we're going into the year with some decent momentum, which is kind of surprising considering the Fed raised short-term rates by 7 times in a row last year. I mean, if you look at the
the economy overall is being led by the consumer. So we have the employment data was positive last year. We had the weekly jobless claims, which are below 200,000. The ISM Services Index popped above 50. Retail sales were pretty good. So the consumer is sort of helping the economy along, and so far that hasn't really changed. We are seeing some warning signs, and that's something we need to be aware of. We have an inverted yield curve, which historically has led to recession. We have the leading economic index, which has been down something like 10 or 11 months in a row. So there's some indicators which historically have led to weakness, but we haven't seen that yet. And so again, we've been off to a pretty positive start to the year. I think what's going on today is that some of the positive tailwinds that helped support the market over the last month or so are sort of being unwound a little bit. And by that, I mean the weakness in the dollar, lower bond yield, and better inflation outlook. So those are some of the things which investors are sort of reassessing.
Do you think that the growth that we're seeing in the market is good news because, like you said, it's driving the economy a lot? Or is that growth ever considered bad news, Michael, because growth means potentially higher interest rates?
Well, that's a great point. Over the past several months, 6 to 12 months, there's been sort of this battle where good news is bad news or bad news is good news, and keeps sort of like a rotating sort of carousel. And today, more recently, we have a situation where good news is bad news because it means the Fed's likely going to have to raise rates. So now the forecast is, the consensus right now is that the Fed's going to have to raise rates probably by 3 more times by a quarter point each, which would leave short-term rates at about 5.5%. And then the Fed would probably remain on hold for a period of time without cutting rates next year. So that's sort of what people are assessing. And then the question is, if that's the case, what kind of downturn do we see for corporate profits and the economy over the next several months?
So is it a case where you feel like you have great visibility? And I guess, Michael, I bring it up because, you know, we heard from the Walmart CFO earlier who says, you know, there's just a lot we don't know, which is why the company is being cautious in their outlook and talking about we could tilt into a recession. We don't know what happens to consumer spending. We don't know what happens to layoffs or household income. We're so early into the year and there's a lot of unknowns right now. And I feel like we're hearing that from a lot of folks. Ken Rogoff on surveillance over a week and a half ago or so. I'm obsessed with what he had to say. Smart guy, understands market cycles. And again, saying, you know, we don't really know what happens because we have not lived, most of us, coming out of a pandemic or an environment where money was so cheap for so long. So there's a lot of unknowns. Do you feel that way? Because you sound rather positive.
No, I agree. Unfortunately, there are going to be twists and turns throughout this year. We, as your other guest had talked about, we came out of the pandemic, the COVID pandemic, we had a massive jump in the money supply, and then we had a massive decline in the money supply. We're living through times and events that we haven't seen forever, possibly. And so that's creating a little bit of a cloudy sort of window into the future right now. Our thinking was that we'd have some weakness in the first part of the year, and then once the Fed moves to the sidelines, then investors would look ahead and the outlook for the markets would improve as investors look ahead to a rebound in the economy and corporate profits into 2024. But now we're starting out with a somewhat better economic outlook, at least in the first part of this year. So that kind of means if the Fed keeps raising rates and then stays on hold, that the economic recession or a period of weakness could actually be pushed out somewhat. So that does make the outlook and trying to figure out the direction of the economy and the markets a little more challenging.
So, Michael, you said in your note that you are not a big fan of speculative stocks right now. So where do you put your money right now? What's the best place to put your money to work in this environment?
Well, a couple of things. One is right now we're overweight generally in healthcare, energy, and financials. And I think in terms of the markets, the past decade or so was all about tech. You had to own the large mega cap tech stocks, and that helped growth dramatically outperform value. But I think in the current market environment, with higher interest rates and higher inflation, you want to be more balanced in terms of the style box between growth and value. And you want to have some foreign, but I think it's a little bit early to overweight or get too aggressive in foreign just yet. For that, you need to watch the dollar.
Yeah, we talk a lot about the dollar and obviously a lot of important implications, certainly on the multinationals, but also for a lot of foreign markets. Hey, Michael, good to check in with you on this Tuesday. Michael Sheldon, he's Executive Director and Chief Investment Officer at Hightower RDM Financial Group, joining us on the phone from Westport, Connecticut. Maddie, we've got just about 10 minutes left in the session. We're still down about 2.3% on the NASDAQ 100, S&P a decline of 1.8%. And if you look at the treasuries, right now we've got a 10-year with a yield of 3.95, 5 2-year note with a yield of 4.72. More on the markets in a moment, right here on Bloomberg.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Home Depot shares now down 7.2%. Stocks lower across the board. 7 minutes to go until that closing bell clangs in New York. Home Depot tumbling after it forecast a fiscal year profit decline alongside plans for a billion-dollar wage investment for hourly workers. Walmart's profit forecast for the year fell short of analyst estimates, signaling more struggles for the world's largest retailer. Walmart shares up by 0.6%. Amazon is getting deeper into the meat of the fresh food delivery service, especially overseas. Bloomberg's Denise Pellegrini explains.
Charlie, Amazon is leading a more than $100 million funding round in the online meat and seafood delivery startup Fresh to Home Foods. And in this investment through its Indian venture fund, Amazon is actually making its first investment in a branded direct-to-consumer food market in the country. Now, Fresh to Home Foods says it delivers fresh meat and seafood free of preservatives and antibiotic residue to more than 160 cities in India and in the United Arab Emirates as well. Amazon, I should mention, also delivers fresh and frozen products through its own grocery service in the country. But the way it's pouring money into this Fresh to Home startup, Charlie, is really notable on another front, because this has created a rare unicorn in the current depressed venture funds market.
And that's Denise Pellegrini. We've got Amazon shares down by 2.5%. Union Pacific, the railroad, has reached an agreement with two of its unions to provide up to 7 days of paid sick leave. Those are some of the company stories we're following. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week on this Tuesday. Tim, as you know, is on leave. Bloomberg Quick Take correspondent Madison Mills is with us, and we're getting ready to catch up with our TV colleagues once again and talk about the market day. It's certainly a risk-off one, and we'll get to it in just a moment. In the meantime, great story. It's one of our most read. You saw this morning. I saw a great headline, and the headline is, South Florida's anti-Cathie Wood quietly building a stock behemoth.
I love this story because I'm fascinated with the pro and anti, I guess, Cathie Wood commentary, Carol. And I wonder what you think about the anti-Cathie Wood investment strategy, because you've talked to Cathie Wood so many times. I feel like you know her insights so well.
Well, I've certainly talked to her a lot of, over the last 7-8 years since she began. And, she really came out with a strategy that I think, kind of took the world by surprise, and a lot of people weren't necessarily backing. She was a big early backer of Tesla. But what's interesting is, of course, it's the innovative, the disruptive kind of philosophy. Her fund took off. It attracted a lot of money, billions of dollars, really grew. And this is where this story is kind of being compared in that, she's been out there. She uses social media. She puts her investment ideas there, out for the public to comment on it. This is somebody, it's the GQG Partners. It's the co-founder, Rajiv Jain, and he doesn't have a Twitter account, doesn't go on TV, which is something Cathie does a lot. We know that, and we appreciate when she gives us time. But they brought in a lot of money, and they've got a $92 billion powerhouse, and they brought in about $8 billion in fresh investment I guess recently, so they're attracting a lot of money.
A lot of money.
I don't know if that's an answer, but
no, that's a great answer.
But a different strategy in terms
different
of
strategy.
Not out there publicly as much.
Yeah, it's like the opposite of what the cast of characters I feel like we end up talking about a lot of the time here at Bloomberg. What's interesting too about this is that in this story they talk about how this investor plunks down a lot of money on individual stocks and then just completely bails on that investment strategy in a heartbeat. So that's a very risky, but I guess obviously high reward move.
And different from what Cathie does, who tends to take positions and really stay, but she does move in and out in terms of buying and selling. So it's a great read. We just scratched the surface. So check it out at Bloomberg.com or check it out on the Bloomberg terminal. All right, I'm Carol Masser along with Maddie Mills. We're heading over to our TV colleagues to talk about the markets because Bloomberg's Beyond the Bell starts right now.
Well, we're
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the Tuesday trading session, the first session this week. I'm Vonnie Quinn along with Shonali Basak, counting you down to the close. And here to help us take us beyond the bell with a global simulcast, we're joined now by Carol Masser and Madison Mills, bringing together our Bloomberg television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day, Carol.
Yeah, it's been an interesting day, and it's certainly been one that's been a clear strategy in terms of trading. If you look at the equity markets, we've been down pretty much all day here, and a lot of it has to do with the move up once again that we've seen in yields, really a new yield range, if you will, and that has certainly put more pressure on the equity trade and how we think about valuations, Maddie.
Yeah, and as we're seeing, the S&P is down by about 2%, and consumer discretionary is really driving that down, Shonali, down by about 3% today, following some of those weak results from Walmart and Home Depot this morning, Shonali.
Yeah, and you've got to wonder here, if it was only a yield trade, you would see the S&P really moving down in conjunction with the NASDAQ moving further. You did see that, but to the point you're making here, you really saw those consumer stocks take a hit off the back of a lot of those earnings as well. So you're starting to see the Fed doing what it does, impact the economy, but investors are not able to turn around on it yet.
We just hit 23 on the VIX, Carol, and I think we all know that there's no better signifier of volatility, obviously, in equity markets than the VIX, and we haven't seen 23 for the VIX in quite some time. The MOVE index by contrast, is actually turning lower. Rates volatility is lower, and perhaps that's because people are finally repricing that yield curve.
Yeah, we've seen a fair amount of complacency, a lot of bullishness, sentiment, certainly on the equity trade, but it does certainly feel like a different tone today, Bonnie.
Well, we are selling off right into the close. We were off our lows of the session until just a few moments ago, but as you could possibly predict, now we are seeing the lows of the session for some of those major indices. The S&P 500 down 2% on the nose, the Nasdaq down 2.5%, the Nasdaq 100 down 2.4%, and the Dow Jones Industrial Average down 2.1%, Carol.
All right, taking a look at the S&P 500, the most to the downside since mid-December, so this is pretty significant. And if you look at the S&P 500, we're going to get into the industry groups, but you're looking at most names in that index, Shanali, 467 to be exact, to the downside, 36 actually gaining some ground, so definitely a lower trade here across the board.
Certainly, and some more than others. If you take a look at the sectors here, you're watching the auto part of the sector move down more than 0.4%, but really red pretty much everywhere you look.
All right, so let's get to it. Some of the gainers, because there were a few standouts. And General Mills, it was top in the S&P 500 today, holding on to a big portion of its gain at its highs today, up more than 6%, finishing the day, though, with about a 4.5% gain. The company boosted its annual earnings per share and organic new sales forecast. They presented at the big nonprofit consumer analyst group conference today earlier, and they did say customer orders in its pet business have accelerated nicely. Those are the words they used. So far in the third quarter, the company remains on pace to deliver double-digit organic net sales growth for that segment specifically. All right, we talked a lot about consumer discretionary today because we heard from Walmart in particular, and that stock all over the map. At its lows today, down almost 3%, at its highs up 1.3%, finishing the day with a gain of 0.6%. A blowout quarter, more shoppers seeking out lower prices, but they did put out a cautious outlook for the current fiscal year because of rising economic uncertainty. Keep in mind, Target, Costco, and a lot of other retailers will start to report next week as well. And then I just wanted to get to a $7 billion market cap pharmaceutical company, Apellis Pharmaceuticals, jumping after the drug maker came out with FDA approval for its eye disease treatment. And so you saw that name up about 5.5%, much higher earlier in the session, up more than 15%, but nonetheless still with a pretty strong performance for the Tuesday trade, Maddie.
Yeah, it's really interesting to look at the Walmart story today in comparison to what Walmart did to some of these other consumer discretionary stocks. Consumer discretionary is pulling down the S&P 500 by a little over 3%. So I just want to run through some of these equities here. We have Home Depot dropping today by a little over 7% rather at the close. The street is not happy with the firm's decision to invest $1 billion in wages, hourly wages for its employees amid those profit declines. And this, of course, again, coming in comparison to the Walmart news from this morning that they're a little bit worried. The CFO saying on Bloomberg TV, we just don't know. We just don't know what the macro environment is going to be doing to that consumer behavior. Target also down by about 4%, and Costco also down by a little over 1% on that Walmart news. The idea being that if Walmart sales declined last year, we'd see that in the data for these other companies, for Costco and Target. And Brendan Case, who covers Walmart for us, was talking with us on radio earlier, and he said it's really important to look at the split between consumer staples and discretionary. Walmart has the benefit of pulling in consumers who are going to be spending on things like food, whereas consumer discretionary companies like a Target may not have that benefit as much. So really interesting to see what these earnings do to the overall market as well.
Well, Maddie, we had a rout in treasuries. I think it's fair to use that word. We saw yields really across the curve move up by double-digit basis points. Look at that, 10 basis points plus there for the 30-year yield. And if you go all the way back to the 2-year yield, we were up 11 basis points, 14 basis points on the 10-year yield. This, of course, after some economic data and also just more time letting all of the Fed speak sink in, and a couple of Fed hawks last week talking towards the end of the week. Non-voters, true, but we do get the minutes tomorrow, so we'll see if there was more of a discussion of a potential 50 basis point move. And definitely more calls now for a third extra rate increase before the summer. Goldman Sachs, the latest, to talk about a 75 basis point increase. We are starting to get some earnings after the close as well. We just got Caesars Entertainment reporting a loss per share, but beating estimates on same-store net revenue. So the estimate there was for 2.81 billion, just beating that by 2.82 billion with that figure there, Carl. And in after-hours trading, we are seeing Caesars Entertainment down about 0.4%.
Yeah, and that's after a pretty nice pop here in 2023. That stock's up about 23% so far. We've seen a lot of the gambling names, whether it's Macau impact as China's been reopening its borders post-COVID, and then also just as the world in general is opening up in terms of travel. But right now, as you said, Caesar, that revenue number, fourth quarter same-store net revenue, 2.82 billion. That's pretty much in line. 2.81 billion was the estimate. Stock, though, now down about 1.9%. So we'll look for some more commentary out of the company's press release.
Yeah, really interesting to read through some of these fourth quarter results here. A loss per share of 70 cents. And we have some also market context I want to read out here as well. Permanently reducing Caesars' total debt by over $1.2 billion during 2022, resulting in total leverage as calculated under our bank credit facility of 4.4 times December of 2022, Shonali. So really interesting to read through some of this context here.
Absolutely, especially, Lisa, you were very smart to point out the credit line here. I was just taking a look at Toll Brothers as well, which recently also had extended its credit line. We're waiting for those earnings after the market as well. Remember, the higher interest rate goes, the more money you're spending on paying down that interest rather than investments and employees and technology and all of the above.
Yeah, we're waiting for Coinbase earnings as well. And of course, we did see a massive move back up this year in that stock, as we saw many sort of stocks that had been beaten down last year, Carol, see massive moves higher. But really the move higher already for Coinbase, about 80% or so, only takes us to where we were at the beginning of last year.
All right, I want to go back to Caesars just because, you know, we heard from Walmart and they gave us some concerns about not having a lot of clarity potentially on the outlook for this year. Well, the company's CEO of Caesars Entertainment, Tom Reeg, commenting and saying consumer demand remains strong in all of our verticals and we are optimistic for the year ahead, which is why, you know, pick your company, pick your sector, and sometimes it feels like you're getting two very different stories, Maddie.
It really does, because we've been talking about this for hours because I feel like it's just so interesting to watch Walmart in this space. The CFO saying we just don't know how the consumer is going to respond, and I believe citing that consumer balance sheets are a little bit of a concern. So it really just, you get all of this information from both earnings, from data. We're seeing this red hot consumer data, Shonali, and then I don't know how to parse out this kind of conflicting input sometimes.
Yes, there's some breaking news as we look along as well. We have Coinbase reporting earnings here. Remember that they're diversifying their revenue, and transaction revenues in the fourth quarter, remember this was still in the middle of the rout for cryptocurrencies, declined 12% for transaction revenues, but subscription and services revenue grew 34% to $283 million. You have Coinbase already highlighting here cutting expenses to position for improving financial performance. You have so far the market liking the initial reaction. Shares are up 5-6%. They're fluctuating after hours, but so far, so good in the current report for Coinbase. And remember, the outlook after that, after the end of December for cryptocurrencies only got better.
Yeah, that's quite a pop, up more than 5%, Coinbase Global, as we speak. Remember, it was just in January that they said that they were cutting 20% of its staff and winding down most of their operations in Japan specifically. So it's certainly been a troubled sector. We know the story over the last year or so, or half year, if you will. But nonetheless, investors seem to be happy about what they're getting. And I think a lot of it has to do with, Shonali, you talked about the transactional growth or transaction numbers, and I think that's got to play into it.
Absolutely, Carol. And also, we are seeing companies guide very conservatively, right? So that perhaps maybe when they come out with earnings, it's a little better than the markets were anticipating. That's certainly what we're getting here. Also, markets were looking to see what kind of mix shift we were going to get out of Coinbase this quarter. It looks like Coinbase at least telling markets that the crypto market cap and volatility have both improved in the quarter, and that's definitely helping the stock. Although right now we have a turnaround and it's actually lower in aftermarket trading by about 5%. So a lot of volatility here.
Yeah, exactly. So we'll keep an eye on it. It's down now about 7%, Coinbase, and Caesars, which we also talked about, it's down about 1.4%. So we'll continue to track it certainly into the Wednesday trade. All right, guys, that's a wrap. Our cross-platform coverage on radio, TV, on YouTube, and of course on Bloomberg Originals. We call it Beyond the Bell. We will see you again, same time, same place tomorrow. in the after hours. Now, over the years, we have touched base with the C-suite team at Curaleaf, including the company's chairman, Boris Jordan, many times. Curaleaf, as you know, approximately $2.7 billion cannabis holding company based in Canada. And we wanted to get more on the business, including last week's news that Twitter would allow cannabis ads, becoming the first major social platform to do so. So we welcome Curaleaf CEO Matt Darin joining us via Zoom in Florida. Matt, good to have you here with Maddie and myself. How are you and how is business?
Doing great, thank you. Business continues to be brisk. We're continuing to see that cannabis is a recession-resistant staple, and despite many of the inflationary pressures and other things going on in the economy, people are prioritizing their cannabis purchases, which is encouraging to see.
All right, optimism. You sound optimistic, but in January, you guys did release that you're cutting your payroll by about 10%. You were closing operations in California, Colorado, and Oregon. At the same time, though, there's some news just last week that you opened another dispensary in Florida. I think it's your 58th in that state, 148th nationwide in the U.S. So first of all, kind of square some things for me. Why the cuts in payroll? Why the shutdowns in California, Colorado, and Oregon?
So a few things. First, Curaleaf more than doubled for a number of consecutive years. And with that hypergrowth comes opportunities to continue to optimize the business. So many of the decisions that we're making, I think, are natural for high growth companies that are going through its next phase of evolution, and is something we're seeing really throughout the industry. As it relates to our markets in the West Coast, look, there are, in a resource-constrained, capital-constrained environment, we want to make sure that we are allocating our capital and our resources to the markets where we see the greatest opportunities, Florida being one of them, with the largest medical market and adult use on the horizon in the coming years. You have some markets such as California on the West Coast that have just experienced some major challenges for a variety of reasons, from lack of enforcement of the illicit market to high tax structures in place that have really made it challenging to be profitable in California. So for the time being, we're continuing to go asset light in those markets, and hopefully they're going to stabilize in the coming years, and we'll be there.
You teased this out a little bit, but can you talk to me a little bit more about why you like Florida as a market to continue to expand in?
So look, Florida has been a wildly successful medical program with over 700,000 patients in the medical program. The licensing structure allows you to expand your cultivation and manufacturing capacity as much as you would like, as well as to open up as many dispensaries. So you can really build scale in the Florida market, which we've continued to do by investing in our manufacturing and processing capabilities and continuing to open new dispensaries, as you've seen. So it's really an attractive market, and that's just in a medical environment. So with adult use on the horizon at some point and 130 million tourists that come to Florida every year, not to mention the demographic shift taking place with many people relocating to the state, it really is an attractive climate to operate in.
How strong is the demand in Florida that you guys have so overweighted your exposure to that state?
The demand is immense. I think part of what we've seen is that there's certain parts of the state that have been slower to, in communities, slower to zone for dispensaries. And so while there are, hundreds of dispensaries throughout the state, there's some areas that have really not had much accessibility for medical cannabis up until recently. So we're seeing some greenfield opportunities in areas outside of Orlando and other parts of the state that we're excited to now be represented in where we weren't before. Same thing in, South and Miami-Dade County. There's areas that are new areas that have been opening up that are now zoned for medical dispensaries, whereby previously that was not an option available. So we're very, very focused on opening up, A locations in these markets, but the opportunities are continuing to open up for that.
Well, we got some big news last week that Twitter is allowing cannabis ads. I imagine that news was music to your ears. Can you talk to me about how big of a deal that is for you and the business?
We see it as a really big deal. Twitter being the first major online social media platform to allow cannabis companies to advertise, albeit subject to restrictions, I think is a real big moment for the industry. Historically, we've been very limited in terms of the digital marketing that we can do and frankly, all types of marketing. And so the notion that we can now advertise and participate in social media channels, including Twitter, which has been very active in the cannabis space, is really a whole new opportunity and something that we're really excited for to capitalize on.
My understanding to advertise on Twitter, that cannabis companies must be pre-authorized by Twitter and meet many requirements. What are you learning about those requirements?
So yes, there are a number of requirements, in the early stages here. We do need to be pre-authorized by the platform to post ads. There's restrictions on what can be advertised. We're not advertising, most cannabis products in general. So there's some significant limitations on, what can exactly be advertised. And there's certain pre-authorizations that are there, as well as jurisdictions where we are able to, offer these ads. So
Matt,
there are a number of
Matt,
restrictions.
help me out. Is this correct that one of the most significant restrictions is that cannabis companies can't promote or offer for sale cannabis products? Isn't that what advertising is?
You are correct. Now, we're able to offer, advertise certain products that are at a very de minimis amount of THC, things like our outstanding topicals, which do quite well in places like Florida. But you're right. There are a lot of restrictions in terms of actually advertising the products that we dispense. But I will say that is still progress from where we have been at, where we've not been able to have any sort of advertising presence on these platforms. So while certainly we're more limited than conventional CPG companies and others, this is progress from what we've been dealing with the last decade. So we'll take progress for the moment.
Are you also a little nervous, and it just harkens back to kind of cigarettes, this whole idea that you can't target minors? I mean, like, how do you not?
Well, I think there's something that we take very seriously. Curaleaf's roots are as a health and wellness company coming out of the medical space, and that's still very much in our DNA. Even as we transition to adult use and are offering products across a variety of ways, there's certainly ways to market and advertise that are not being directed towards youth and that in terms of the way that products get presented and many of those things. So I think there's absolutely ways to market cannabis products, and the reality is a huge portion of our customer base is kind of skewing older than younger is the reality.
And forgive me, I really probably should have phrased it more like it's hard to avoid anybody from seeing the ads that are out there. I didn't mean to mean that you guys are necessarily going to target young folks, but I mean, once the stuff is out there, pretty much anybody can see it. Matt, come back, because I'd love to continue this conversation and love to know more as you guys find out about the advertising rules. Matt Darin, he's Chief Executive Officer of Curaleaf, joining us via Zoom from Florida. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg. Lots of earnings after the close of trading. Palo Alto Network shares up 5.8%. The security software company reported second quarter results that beat expectations in terms of revenue and billings. Coinbase reported revenue for the fourth quarter that beat the average analyst estimate, while trading volume missed estimates. Caesars Entertainment reported earnings after the close. Shares now lower by 2.4%. This headline from the Bloomberg Professional Service: Bank of America's head of credit sales is departing as the bank resumes cuts. And sources say the Federal Trade Commission will not challenge Amazon's $3.5 billion acquisition of One Medical Parent, One Life Healthcare. That's a move that will allow the deal to close later this week. A losing day for stocks today, holiday shortened trading week, and the Dow Jones Industrial Average today wiped out all of its gains for the year. The Dow was down 697 points, a drop of 2.1%. S&P down 81, a decline of 2%. NASDAQ today down 294, a drop there of 2.5%. 10-year yield 3.95%. Two-year, 4.72%. Spot gold down $6.50 the ounce to $18.34, a drop there of 0.4, while West Texas Intermediate crude was down 0.2%, $76.16 a barrel. So again, recapping, stocks move lower today, Treasury yields higher, S&P down by 2%. And that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie Pellet. Bloomberg Business Week brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. There is more pandemic relief available to claim for small and medium-sized businesses. The ERC is a refundable payroll tax credit your business may qualify for, even if it already received PPP. Let the tax professionals at Innovation Refund show you how to get the money your business may be eligible to receive with no upfront costs. GetRefunds.com for more information.
So there's a lot of geopolitical tension going around the world right now, Carol, and the continued role of the U.S. to provide defense and support as needed to global allies is a huge story again. It feels like the defense industry from the U.S. is really back in the spotlight. So that's why today's Bloomberg Big Take is really important to us. It's about the dysfunction happening at the U.S. Pentagon, and this is really alarming. The story is also among the most read today on the terminal.
It is indeed. And let's get more. Let's bring in Bloomberg News global defense and intelligence correspondent Peter Martin with us on the phone from Washington, D.C. Peter, thank you so much for joining us. By the way, Peter's story and more from Bloomberg, as we said, the Big Take on Bloomberg and at Bloomberg.com. So, Peter, tell us what's going on that shows the dysfunction specifically at the U.S. Pentagon. This was a program that was going on for a long time and that the government spent billions of dollars on it. Tell us about it specifically.
With Army's Teacher Combat System, which was one of the costliest programs the Army had ever undertaken, and it was supposed to help modernize the Army's fighting ability. But in 2009, after spending $20 billion in 8 years on the project with nothing to show for it, the Pentagon ended up canceling it. And we saw that as kind of one marker of a much broader set of problems which have really become central in the minds of policymakers over the last 18 months as deficiencies with munitions stockpiles have become apparent, and cost overruns and problems with the defense supply chain have all kind of come to the fore.
So that $20 billion that you mentioned, Peter, is that totally wasted, or does that go towards anything that's helpful?
No, we talked to people who were involved in the program, and they said that some of the research that had been done for it had been useful for other systems and had been put to good use elsewhere. But I think the impression overall is that a lot of that effort went to waste.
Why are we here? Why are there problems?
I'm sorry, say that again?
Well, Peter, how did we get to this point, essentially? Like, why is it that all of a sudden, you're talking about revealing the cracks in the U.S. war machine? How did it get to this position? What are the bigger, broader problems?
So I think there's a realization that at the end of the Cold War, the U.S. tried to save money and cash in on peace dividends
We're having a few technical difficulties, and we're hoping we can get back to Peter Martin on his Bloomberg Big Take story. We'll see if we can get back to him. He's out there in the nation's capital. But I do think this is a story, Matt, I was thinking about when we kicked off the broadcast, and you and I were obsessed with President Biden and what it took to secretly get him to Kyiv over the past weekend. But geopolitical, I'm hearing from more and more market watchers that it is top of mind in terms of what happens to the global economy, what happens to global financial markets, and defense certainly plays a big part of that.
A huge part of it, and it also takes a lot of money, right? And I think that's a really interesting piece to watch, this debate that we talk about all the time going down in Congress of whether or not to take spending away from military and defense and put it towards social programs, what have you. And that's why I wanted to ask Peter that follow-up question about, did that $20 billion do anything, or did it totally get wasted? Because that's important to a taxpayer.
Right? Right. It's a good point. Like, did we discover some new technologies that we can put to work elsewhere? And what's interesting is, a country doesn't develop its defense systems, in a vacuum, right? You have to be looking at what's going on around the world. And I think the Chinese balloon, which we also talked about earlier, the surveillance balloon, kind of made everybody sit up and take notice in terms of potentially China's technological prowess, if you will, when it comes to surveillance and what that means potentially. And so we have to be looking at what else is going on around the world.
Yeah, and I love, you asked him about this, but it's really well said in the story. Munition shortages, failed audits, and surveillance gaps exposed by the Chinese balloon, ultimately shot down, of course, suggest that America's military-industrial complex may no longer be fit for its purpose. So a lot of colliding factors. We talked last week about some of the ammunition shortages that are impacting the war in Ukraine, coming up on that one-year anniversary. Then we've also got these failed audits, and we've got the balloon. It feels like it's all colliding at the same time. And again, to the point of the article, really highlighting some of the big questions about missteps occurring within the industrial complex.
And you have to look at the historical story, right? You go back to the Cold War, right, with Russia, when there was just such military buildups, whether it was over in Eastern Europe and what was going on certainly in the United States and among its Western allies. And there's a great paragraph in Peter's story that talks about, in the wake of the Soviet Union's fall, U.S. politicians hope to cash in on the peace dividend, the promise of economic benefits from reduced defense spending, which is kind of what you were talking about earlier, in terms of money spent on defense versus elsewhere. And if it's not productive, what are we losing out as an economy in a country? But what's interesting is, too, that the number of aerospace and defense contractors have really fallen. There were about 70 in 1980 to just 5 by the early 2000s, the same number as today. So we're talking about Lockheed Martin, Raytheon, General Dynamics, Northrop Grumman, and Boeing. So it's a very different sector, a lot fewer players, and of course there was some consolidation that went on to create some of the big behemoths in the defense space, but it's very different.
Yeah, in the story they talk about consolidation. The defense sector has moved from more than 70 aerospace and defense prime contractors that worked directly with the government, and that has of course decreased, as you were mentioning.
My dad worked for a private company, but they often bid on government contracts, and that whole process too. And if you only have a smaller pool to go to, this story talks about some major projects end up with just one bidder. Are you getting potentially the best bid or the best ideas or the best technology? And you do wonder, when you pull away some of the competition, and this is why, government officials, antitrust officials are very careful to make sure that there are more players in various industries to make sure there is that competition, and so that there is that innovation and technology that continues, or whatever within that particular industry, that there's lots of choices, if you will.
And you have to wonder, that seems even more critical in the face of U.S. competition with China, not only over kind of the mental equity of figuring out the best defense systems, but also the fact that we use a lot of products and products from China in our defense supply chains. And I wonder what that impact looks like as we kind of deal with some of the geopolitical tensions that are only continuing to rise between the U.S. and China. So that's another just issue that Peter's story talks about. A third shock as regards to the U.S. ability to counter China is the use of Chinese-made components in our defense supply chains.
All right, now, you know how we always talk about there's like kind of an Elon Musk component to everything? Well, there is to this, of course, and we know Elon has been very involved in terms of space launches. We know that. But it also, the element there is, you know, he has seen the Pentagon regulations that have existed, which largely have shaped the way defense companies work specifically. And so, as Peter writes, the result is traditional defense contractors are adept at maneuvering the onerous regulations process required to do business with the Pentagon, where startup firms are not. In other words, they have an advantage. They understand how it works. They understand the regulations, and they can easily navigate. And maybe that cuts out someone like an Elon Musk potentially, or some others within the private sector, your non-traditional defense players. And what does that mean in terms of maybe getting the greatest and best when it comes to our defense system? Anyway, it's an incredible story. We're so sorry that we lost Peter Martin, but we highly recommend that you head to Bloomberg.com to check out the Bloomberg Big Take today, written by Peter Martin, our global defense and intelligence correspondent here at Bloomberg News, because it really fits into so many bigger, broader stories that are going on right now.
It'll make you much smarter if you read this story.
It's really great, like the detail and the historical perspective when it comes to our defense industry. All right, folks, you are listening and watching Bloomberg Business Week. More to come, certainly here on Bloomberg Radio, including a look at e-digital health company Arista MD and their take on the CVS Health deal to buy Oak Street Health. That's coming up. All right, let's get a check on world and national news. Nancy Lyons, she's in D.C. Hey, Nance.
Hey, Carol. President Biden is vowing that Ukraine will never be a victory for Russia, ever. He spoke today in Warsaw, nearly a year since Vladimir Putin launched his invasion. Biden says when the fighting began, there were questions about how the world would respond.
Would we stand up for the sovereignty of nations? Would we stand up for the right of people to live free from naked aggression? Would we stand up for democracy? 1 year later, we know the answers. Yes, we would stand up for sovereignty, and we did. Yes, we would stand up for the right of people to live free from aggression, and we did. And we would stand up for democracy, and we did.
Biden says it's important for NATO and other U.S. allies to remain firm in their commitment to push back against Russia. Well, his speech came just hours after Putin himself announced that Russia will suspend its observation of the START treaty. It means Russia will no longer allow U.S. and NATO to inspect its atomic weapons. NATO Secretary General Jens Stoltenberg says the move makes the world more dangerous. U.S. Secretary of State Antony Blinken calls it deeply unfortunate and irresponsible. Well, the Biden administration is taking control of Norfolk Southern's cleanup of the freight train derailment in eastern Ohio, and as Bloomberg's Amy Morris reports, officials are eyeing next steps toward train safety probes.
The federal government is eyeing enforcement tools and a potential emergency order from President Biden to improve rail safety as the National Transportation Safety Board works through what caused the derailment of a Norfolk Southern freight train. President Biden has yet to nominate someone to lead the federal agency that regulates the transport of hazardous materials, and lawmakers are working on legislation to make the transport of hazardous materials by rail safer, and they're promising more oversight. In Washington, I'm Amy Morris, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:41 on Wall Street. We check the markets all day long at Bloomberg. I'm Charlie Pellet. We're keeping an eye on shares of Palo Alto Networks. After hours, that stock now up by 6.1% in extended trading. The security software company reported second quarter results that beat expectations in terms of revenue, also in terms of billings. Coinbase out with earnings after the close of trading. Coinbase Global is the biggest American cryptocurrency exchange. It reported a fourth quarter revenue decline that was less than forecast by analysts, but after hours, Coinbase now down by 2.8%. The Dow, the S&P, and NASDAQ all declined today. We closed at or near session lows. A renewed surge in Treasury yields took the wind out of the stock market. The 10-year, 3.95%. The 2-year, 4.72%. And the Dow wiped out all of its gains for 2023. The Dow today down 2.1%, falling 697 points. S&P was down 81. That was a drop of 2%. NASDAQ down 294, a decline of 2.5%. Well, as for the market mood, Michael Sheldon is Chief Investment Officer at Hightower RDM Financial Group, and he was our guest right here on Bloomberg Business Week.
I think what's going on today is that some of the positive tailwinds that helped support the market over the last month or so are sort of being unwound a little bit. And by that, I mean the weakness in the dollar, lower bond yield, and better inflation outlook. So those are some of the things which investors are sort of reassessing.
And again, the 10-year yield today, 3.95%. Spot gold down $6 the ounce to $18.34, down 0.4%. West Texas Intermediate crude down 0.2%, $76.16 a barrel. Again, recapping the Dow, the S&P, and NASDAQ all lower today. S&P was down 2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, Bloomberg Business Week, it is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. There's still time to claim the Employee Retention Credit. Unlike the PPP, the ERC is not a loan. Business owners can use the ERC to expand their company, pay off debts, or hire new talent. The money is there to help your business as you see fit. Learn more at getrefunds.com.
Well, earlier this month, CVS Health agreed to buy Oak Street Health in a $10.6 billion deal that'll further integrate primary care into the major healthcare conglomerate that is CVS, positioning it to take advantage of a shift in how medical care is paid for. Time is going to tell, of course, what moves like this will ultimately mean for the cost and quality of the healthcare, Carol.
Yeah, Maddie, we're all watching. With some thoughts on the deal, with us is Brooke Levasseur, CEO at the e-digital health company Arista MD, joining us via Zoom from San Diego. Hey, Brooke, good to have you here on Bloomberg Business Week. Tell us about your business and exactly what you guys do, and who are your biggest clients or customers?
Sure thing. Thanks so much for having me. So we have a huge problem with specialty care access in this country. It's really difficult often, and it's extremely costly. So what our company does at Arista MD is we try and remove all of the barriers involved in getting patients timely access to the specialty care, and we try and do it in a really cost-effective manner. We use two main tools here. We have referral management solutions that remove a lot of administrative burden involved in getting patients to the right provider and the right set of care. And then we have what's called an e-consult or electronic consult solution that really helps providers collaborate, because sometimes patients don't have to be seen in person. You know, you can let the primary care provider connect with a specialist to talk about the best pathway forward for that patient and immediately execute on that care.
So, Brooke, break it down. So I go in to see a doctor and I've got something going on. Tell me exactly kind of how this plays out in lay terms.
Sure. So you show up to your doctor, and you know, the primary care office sees every type of condition. They really are the entry point into the healthcare system for so many patients. Well, they're seeing everything under the sun, and you come in and might have something they haven't seen for a while, where there's a new workup they're not really up to speed on. And so what do they do today? Well, quite often they will just kick you out of their office to a specialist, get you off their plate, and send you often on a very long exploration where you're waiting on a wait list and trying to get in to see a specialist to resolve this issue. What we found is that the majority of those cases can actually be handled when you just empower providers to collaborate together. So if you can have your primary care provider enter information into an electronic platform that has detail around what's happening with the patient, might have lab results or images that you could attach, and then send that off to an on-call specialist, you can start to have a really robust virtual consult between providers that will really educate the primary care provider on what should happen next with the patient, and often immediate treatment steps that they themselves can carry out.
So can I just ask you, so does that consult then virtually have to include your primary and another doctor, all of this happen in real time? Because I'm just trying to figure out. Okay.
Yeah, what's great about this is you can do it asynchronously. So we all know doctors have no time. They have very short office visits. So you come in, you see your provider, they'll take down all the detail on your case, and overnight they can send this case out. On-call specialists can review and send back a recommendation to the provider so that the next day they can pick up the phone and call the patient or send them an email updating them on what they're going to do with the patient next. There's no need to coordinate schedules or wait around to bring all the parties together at once.
Obviously, it saves the patient a lot of time, but does it also lead to any cost savings for patients?
Absolutely. We know today that over 70% of routine referrals to specialists are unnecessary. These are issues that are lower acuity, less complex, and can be handled by primary care, which is, a fraction of the cost of what it takes to send a patient out to a specialist. Not only is a referral usually one visit to a specialist, but those add up. The first visit is a workup, and on average, we know every referral is usually 3+ visits. So the dollars really start racking up. And when you can pull that back and have the patient treated immediately at primary care, there's huge savings to be had.
So help me out here, because in terms of, for those of us who have great medical plans, which we do here at Bloomberg, you stay in network or whatever, or certain providers, you certainly can keep costs down for the individual. But what I'm wondering is, does it lead to better health care? Because I often find when I pop to a specialist or go directly there, because I know my body really well, that I usually get something dealt with much more quickly than kind of go into my primary care and then maybe doing a couple of things before I get to ultimately a specialist anyway.
Yeah, definitely. I mean, I think your experience is actually in the minority. Most folks are waiting to get care. We have just a huge shortage of specialists in the country, and not enough doctors, and the doctors aren't necessarily located where the patient need is. So in most places around the country, patients are not getting into specialists very quickly. They're actually waiting sometimes months to see the specialist. And in the meantime, their condition is getting worse. So for so many individuals in, rural locations, places where you're having to travel for hours, the ability to have your provider that you already have in your back door, that you've built a relationship with, have them consult with the specialist and then continue to treat you, can solve a lot of barriers to you getting that care, period.
So Brooke, talk to us about the CVS deal and its impact on consumers and what you think about the deal. How do you rate it?
Yeah, well, early to tell. I mean, I guess we have to see it close and then we'll see how it's executed. But face value, I mean, it obviously makes a lot of sense. We've all been waiting to see how CVS is going to carry out on this strategy to really be the front door of care for patients. And I think Oak Street makes a ton of sense on a bunch of different levels for CVS. First, they have deep experience around Medicare Advantage. I think that's a real easy early win for CVS and Aetna, a way to hopefully see off the bat an increase in member retention for them, even an increase in quality scores. And I think, conversely, CVS Aetna has the ability to then build the funnel and to help acceleration and scale on the Oak Street side. And hopefully that will result in faster profitability for those clinics.
Hey, Brooke, we're actually running out of time, but it would be really great to have you come back and talk a little bit more about your business, because I'm curious about the growth that you guys are seeing and the uptick among different types of providers. We do have to run. Much for your time this afternoon.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. New York-based McKinsey plans to eliminate about 2,000 jobs, one of the consulting giant's biggest rounds of cuts ever. The firm, which is known for devising staff reduction plans for its clients, is taking the axe to some of its own, with sources saying the move is expected to focus on support staff in roles that do not have direct contact with clients. Walmart's profit forecast for this year fell short of analyst estimates. However, the stock moved higher. It did signal more struggles for the world's largest retailer after it was hammered by a surge in inventory. Walmart today up by about 0.6%. John David Rainey is Walmart's chief financial officer. He told us today there is a lot of macro uncertainty.
As we look across the consumers across the globe, but certainly here in the U.S., balance sheets are getting thinner. You're seeing savings rates decline, and we really haven't been in a position where we've seen the Fed tighten at this rate. And so as we look forward and give guidance for the full year, we're adopting a cautious outlook, and we want to make sure that we're responsive to whatever environment that we're going to find ourselves in.
And again, we did have Walmart up by 0.6%. Also reporting today, another big retailer, another member of the Dow, Home Depot. That stock today down by 7.6%. Palo Alto Network shares advanced more than 5% in extended trading after the security software company reported second quarter results that beat analysts' expectations in terms of revenue and billings. And those are some of the company stories we're following this hour. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week. It is brought to you by Innovation Refunds. But first up, we're going to get to that in just a moment. First up, let's get a check on world and national news. Off to 99.1 Newsroom in Washington, D.C. Hey, Nance.
Thanks, Carol. President Biden is restating the U.S. commitment to the defense of Ukraine and the unity of the North Atlantic allies. He spoke in Poland today after making a surprise visit to Ukraine over the weekend. Bloomberg's Irv Chapman has the latest from Washington.
The president lauded the Ukrainians for their heroic and effective efforts.
Kyiv stands strong. Kyiv stands proud. It stands tall. And most important, it stands free. Yes, we would stand up for the right of people to live free from aggression, and we did. And we would stand up for democracy, and we did.
The president said Ukraine will never be a victory for Russia, and he assured the Russian people, the nations of Europe and the United States, are not seeking to control or destroy Russia, as Putin alleges. In Washington, Irv Chapman, Bloomberg Radio.
Federal environmental regulators are taking charge of the cleanup from the East Palestine, Ohio train derailment and chemical burn, and also ordering Norfolk Southern to do the work and foot the bill. EPA Administrator Michael Regan says the railway will be held accountable.
If the company fails to complete any action ordered by EPA, the agency will immediately step in, conduct the work ourselves, and then force Norfolk Southern to pay triple in cost accordance to the powers granted by my agency.
Regan says there's no way Norfolk Southern will get off the hook for, quote, the mess they've created. Transportation Secretary Pete Buttigieg is also vowing to strengthen regulations concerning high-hazard flammable trains. Alec Murdaugh's only surviving son has been on the stand today in Murdaugh's South Carolina trial for the murder of his wife and son. Buster Murdaugh, testifying for the defense, says his father broke the news in a phone call in which he says he sounded odd. He also told jurors his father had been destroyed and heartbroken following the murders. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Carolyn Madison.
All right, Nancy, thank you so much. Bloomberg Business Week, it is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds to see if your small to medium-sized business qualifies for a payroll tax refund. If your business was impacted by the pandemic, this is your opportunity to take control of your business's future. Learn more at getrefunds.com. Well, coming up in just a moment, of course, Sound On with Joe Matthew, and Joe joins us right now for a preview. Joe, I'm assuming D.C. is still buzzing over President Biden's surprise trip to Kyiv this past weekend.
Yeah.
I am still, it just blew my mind.
Yeah, incredible story. And it's incredible to read the TikTok, from the two reporters who were there for that whole ridiculous journey. Imagine, I don't know, guys, 10 hours on a train both ways. That's a lot to ask, but he pulled it off, and it was an incredible walk-up to this speech today. The optics, I don't know if you saw this today in Warsaw, the optics were rock star level. I mean, it looked like staging for a U2 concert.